What if I told you that one of the most responsible financial decisions millions of families make every single year is actually quietly draining their wealth? Not a scam, not something illegal, not some shady scheme in a dark corner of the internet. Something completely normal, something you've probably seen advertised on TV, something a trusted professional, someone in a suit sitting across a nice desk, may have recommended to you or someone you love. And here's the part that makes it truly dangerous. It doesn't feel like a mistake. It feels like protection. It feels like love. It feels like exactly what a smart, responsible adult is supposed to do. That's what makes this trap so powerful. You don't feel it working against you. Not in month 1. Not in year 3. Sometimes not until it's already cost you $40,000 or more. So today, we're pulling back the curtain. And once you see what's really happening inside one of the most popular financial products ever sold to everyday families, you will never look at it the same way again. If you're someone who wants to understand how money actually works, not the version they sell you, but the real version, make sure you hit subscribe. We break down personal finance, money psychology, and wealth building every week in a way that actually makes sense. Let me introduce you to Daniel. Daniel is 29 years old. He just got married. His wife is pregnant with their first child. He's not rich, but he's doing okay. He has a steady job, a small savings account, and a genuine desire to do right by his growing family. One afternoon, he sits down with an insurance agent. The agent is friendly, professional. He asks Daniel a simple question. What happens to your family if something happens to you tomorrow? Daniel has no answer. Of course he doesn't. He's 29. He hasn't thought much about dying. He's thinking about strollers and hospital bills and saving for a house down payment. The agent nods like he's heard this 1,000 times, because he has, and slides a brochure across the table. I want to show you something that not only protects your family, but also builds real savings over time. It's called whole life insurance. Daniel leans forward. And honestly, it sounds incredible. You get a death benefit that covers your family forever. You get a savings account built right into the policy. Your money grows tax advantaged. And the agent tells him it's a guaranteed, safe place to build wealth. Daniel signs up. About $280 a month. He leaves feeling like the most responsible man on earth. What Daniel doesn't realize is that he just made a decision that will cost his family over $40,000 in lost wealth over the next 30 years. Here's the thing our brains do that makes this so easy to fall into. Psychologists have a name for it, loss aversion. The idea is simple. The pain of losing something feels about twice as powerful as the joy of gaining the same thing, which means fear, especially the fear of something happening to your family, is one of the strongest forces in all of human decision-making. Insurance companies know this. They've built entire marketing empires on that single fear. What if something happens to you is one of the most emotionally powerful sentences ever written. It doesn't ask your brain to think. It asks your gut to react. And your gut says, do whatever it takes to protect the people you love. Whole life insurance is the product designed to be the perfect answer to that fear. Protection forever. Savings built in. Feels responsible. Feels permanent. Feels safe. But let's open the hood and actually look at what's happening inside. When Daniel pays his $280 every month, that money goes into 3 buckets. One bucket pays for the actual insurance, the death benefit that covers his family. The second bucket goes to the insurance company as fees and commissions. And the third bucket goes into something called the cash value, which is the savings component the agent was so excited about. Now here's the problem. In the early years, bucket 1 and bucket 2 eat up most of that $280. The cash value, the part that's supposed to grow, barely moves. We're talking about a few dollars a month building up in those early years. Meanwhile, that same $280 invested somewhere else would be compounding and growing at a completely different rate. Let's do a simple comparison. A term life insurance policy, which is the alternative, covers Daniel for a specific period, say 20 or 30 years, while his kids are young and his family actually depends on his income. It has no savings component. It's just pure protection, and it costs a fraction of the price. For For the same level of coverage Daniel got with whole life, a term policy might cost him $30 to $40 a month instead of $280. That's a difference of about $240 every single month. So here's the real question. What happens to that $240 difference? If Daniel just spends it, it's gone. But if Daniel invests that $240 every month into a simple index fund, something that tracks the broad stock market, history tells us he could expect average returns of around 8 to 10% annually over the long run. Run that for 30 years, and that $240 a month doesn't just become $86,000 in contributions. Thanks to compounding, it grows into somewhere between $270,000 and $325,000. That's the real cost of the whole life trap, not just the extra premiums, but the enormous amount of wealth that never got a chance to grow. Here's the deeper truth that most people miss. Whole life insurance doesn't feel like a bad product because the people selling it aren't bad people. Most of the agents who recommend it genuinely believe in it, and the product itself isn't fraudulent. It does what it says it does. Your cash value does grow, slowly. Your family is covered, expensively. The problem is the comparison they never show you. When someone sells you a financial product, they compare it to doing nothing. They say, wouldn't you rather have coverage and savings than just coverage? And compared to doing nothing with the extra $240 a month, sure, a slow-growing cash value sounds fine. But that's the wrong comparison. The right comparison is whole life versus term insurance plus investing the difference. And when you run those numbers, the picture changes completely. This is a pattern you'll find all over personal finance. Products that sound like they do more, that bundle two things together, often do both things worse than if you had kept them separate and handled each one deliberately. Think about it like buying a combo meal just because it feels like a deal, even when you didn't want the drink or the fries. Bundling feels efficient, but bundling often means paying for things you don't need, packaged in a way that hides what each piece actually costs. Whole life insurance is the financial world's combo meal, and millions of families are paying for fries they never eat. There's also a psychological trap inside the product itself called the sunk cost effect. Once Daniel has been paying $280 a month for 5 or 6 years, walking away feels painful. He's already put in thousands. The cash value is sitting there. Canceling feels like losing something, so he keeps paying. But sunk costs are money already gone. The only question that matters is, what does the next dollar do from here? And the answer to that question, in most whole life policies, is almost always the same. It works harder somewhere else. So what should you actually do? First, understand what you actually need from life insurance. For most people, especially young families, what they need is income replacement. If you have dependents who rely on your paycheck, you need a policy that replaces that income if you're gone. Term life insurance does this directly and affordably. Pick a term that covers the years your family needs you most financially. 20 or 30 years is usually the right window. Second, calculate the difference in premiums and take that number seriously. Whatever you save by choosing term over whole life, treat that money like it's already been allocated. Don't let it disappear into everyday spending. Set up an automatic investment into a low-cost index fund, a Roth IRA, a 401k, a brokerage account. Somewhere it can compound quietly over decades. Third, if you already have a whole life policy, don't panic. Don't make any rush decisions. But do sit down and run the actual numbers. Compare your current cash value growth to what that same money could have done elsewhere. Talk to a fee-only financial advisor, someone who doesn't earn a commission from what they recommend. Get a second opinion that doesn't have a sales incentive attached to it. And fourth, remember the real purpose of insurance. Insurance is not an investment. It is not a savings vehicle. It is not a wealth-building tool. It is a risk management tool. Its job is to protect you from catastrophic loss. Once you separate that job from the job of building wealth, everything becomes much clearer. Protect, then grow. Keep those two things in separate boxes. That's the move. Here's the thought I want to leave you with. Daniel from our story didn't make a dumb decision. He made a human decision. He was scared. He wanted to protect the people he loved. He trusted someone who seemed to know more than him. and he signed his name on a document that felt like responsibility. That's not stupidity. That's most of us. The difference between the families that build real wealth and the ones that stay stuck isn't intelligence. It's almost never intelligence. It's information and the willingness to question things that feel safe just because they've always been done that way. $40,000 over a lifetime doesn't disappear in one bad choice. It disappears in 360 monthly payments of not asking the right question. And the right question is never, does this sound good? The right question is always, compared to what? Ask that question. About your insurance, about your subscriptions, about every dollar that leaves your account on autopilot, because the silent drains are always the most expensive ones. If this video opened your eyes to something you hadn't considered before, share it with someone you know who might be paying for the wrong kind of protection right now. And if you want more videos like this, money, psychology, wealth building, investing, explained simply, subscribe and hit the bell. We've got a lot more of this coming, and trust me, you don't want to miss what we cover next. See you in the next one.